Hey everybody, this is Jose Blasco. We are now starting the session. Welcome to the session, everybody. Today is October 5, and this is our trading and review session that we do every month with each of your coaches. I am about to show myself because we still have the introduction slide. So here we go. I am in the bottom right corner of the screen. How are you, everybody? And for the ones of you that you are connected already with the chat, I would really appreciate if you could confirm that you see the stream, because I had a little tiny hiccup on launching the session. Sometimes these things happen, isn't it? I just want to make sure that all is good, sound is good, video is good, and therefore we're ready to go. So please, using the chat box, go ahead and comment on that, so I know that we are good to go, and that way, there are no more delays. Okay, but I'm just gonna be waiting for your confirmation. So please type it as quick as possible. Okay, Mark, how are you, my friend? Joe, good to see you as well. Everyone else, and if you're watching this recorded, of course, hello to you too. Yeah, and we are about to get started. Today we have a special session, actually, because while I'm waiting for your confirmations on the chat box, today we have a special session because we're gonna kill many birds in one stone out of your comments and questions and suggestions that you have phrased for me during the open meetings that we do twice a month on Mondays. And basically, we were talking about calendar spreads. Thank you, Joe, for confirming. We were talking about calendar spreads. We were talking about vertical spreads. We were talking about screening to find the opportunities. So the idea in the end was, okay, what about we do a lesson, a special lecture today, where we go over the whole thing, which is, okay, how do I scan and find my spread, and then how do I construct it and build it and trade it? Okay, so that's the idea for today's session. So it's gonna be intense. Thank you, Mark. It's gonna be intense. It's gonna be fun. And of course, I welcome you to ask questions. As you know, if you're attending this session live, I see you on the chat box. If you are watching this recorded, for sure, you can use the questions section on our website to phrase your questions, or you can email as well. I would say it's better to use the questions section on the website. You just scroll down to the bottom, you will see questions, and you click there, and you type your questions if you are watching this recorded. Anyway, so let's begin, guys. Let's begin our session. Oh, by the way, I did not turn on our financial disclaimer, so here we go. You have it. And so let's begin. Okay, so again, first of all, we need to talk about what's a spread. Okay, what's a spread? And of course, now I'm going back in time all the way. Some of you are going to be like, really, Jose? You're going to talk about what's a spread? Well, yes, very briefly, yes, because I want to make a point and end up comparing the difference between a spread and a spread, kind of like a vertical spread, compared to other types of spreads, such as horizontals. Okay, and for that, I just want to be a bit visual. So I want to talk about first, what's a spread, second, what's a vertical, then what's a horizontal, Then now that we speak the same language and we know what's a spread, vertical and horizontal, we can then move into scanning for them and then how to construct them. Okay, but first we need to understand what they are, because understanding what they are has a direct impact into scanning for them, but also, as you know, options give you options. So the reality is that you could use vertical spreads and horizontal spreads in ways that produce different type of outcomes, which have a lot to do with your chart analysis and your trading methodology when it comes to being directional or non-directional or less directional or more directional, depending on the deltas you need and all of that. Okay, so if you are new to options and spreads, probably I just drove you crazy now. Just listen carefully. I'm going to repeat myself. I'm going to make some notes, and hopefully everything will be understood. So what's a spread? A spread is when we combine multiple options contracts together. Okay, and because options give you options and you have many expiration dates, many strikes, you could have a million different types of spread, and probably even more than a million types of spreads. You can have, the sky is the limit. So what we're going to do today is we will focus on spreads where two contracts are combined at the same time. Okay, so we're going to be using two contracts, maybe two calls, maybe two puts, maybe the same expiration date, maybe different expiration dates, but we're going to stop our combination at two. Okay, you could have, like, for example, an iron condor is a spread where you have four contracts. Okay, we're not going to do that today. We're going to focus on two contracts at a time. And when combining two contracts at a time, you could end up with two calls or two puts combined. And you could also have those calls or puts to have different strike, and I guess I got a little bit of fat fingers today. I have different strike, but same expiration date, and we call that vertical spreads. Or you could have two calls or two puts combined that have a different expiration date. Yeah, definitely fat fingers today. Different expiration date, but same strikes. Okay, same strike, I should say. Different expiration dates, but same strike. Okay, so in other words, visually speaking, a vertical spread would look like something like that. I'm going to use, I'm going to just center this a little bit, and I'm going to use plus for buy, minus for sell. So you may buy a put and sell a put below. And let's say you buy the 80 put and you sell the 70 put. Okay, that's why I said below. 70 is below 80. So you buy a put and you sell a put. That's a vertical spread. Now, of course, you can also sell the 80 put. Okay, so that would be a different case where you could sell the 80 put and buy the 70 put. Okay, so case number one, you buy the 80 and you sell the 70. Case number two, you sell the 80 and you buy the 70. In this case, it's all puts. You will be using the same expiration date, but we are using different strikes. So different strikes and same expiration date. Okay. Of course, the same thing could also be done with calls. Okay, so you could maybe sell the 80 call and buy the 70 call, or you could sell the 70 call and buy the 80 call. So this is very simple. I'm just sharing with you four combinations. It is also very confusing if it's the first time you see that in your life. It's like, okay, wait a moment, Jose, let me think. Well, let me think about this. 80 is above 70. No matter if you buy calls or puts or sell calls or sell puts, 80 is above 70, which means different strikes. Okay, so using the 80 and the 70, one strike is always above the strike that is below, or one strike is always below the strike that is above. And of course, it can be puts or calls. Okay, so the two cases on the left are puts, the two cases on the right are calls. And then you may buy below and sell above. Okay, buy below and sell above, or you could buy above and sell below, buy above and sell below, and therefore you end up with four combinations. I guess it's really common sense, but again, if you've never seen that in your life, it's indeed very confusing at first. All these combinations of trades have names. Okay, so the one on the left, okay, let me try to I'm not sure if this is gonna look too good. So the one on the left is called the bear put spread. Okay, bear put spread. I'm gonna use put like that. Bear put spread. Okay. Now the next one, this one is called bear put spread because it's a technique that makes money on the way down, and because it uses a put, okay, it's bearish. Okay, well actually it's both cases because it's bearish. That's why it's called a bear, and it's called put because it uses put. So it's the two reasons: the application of the strategy plus the type of unit you use. Type of units can be calls or puts, and the application is either bullish or bearish. So the application of the strategy plus the type of units that you use basically give the name to the strategy. So in this case, we are dealing with a bear puts spread. Okay. The next one is a bull put spread. Why is it bull? Well, because if you focus on, again, when you are bearish, and this is coming back to basics of options. So I want to say that very quick because I cannot go so basic. So I'm just gonna say it once. But when you are doing basic option strategies where you buy a put only, buying a put is bearish, where selling a put is bullish. So if I do the second case, where I am selling the put and buying the put below, so the put with the greatest amount of delta is going to be the highest one. Therefore, that strategy becomes bullish. So if you do sell the 80 put, buy the 70 put, and the stock goes up, you make money. So it's a bullish strategy that uses puts. So we call it a bull put spread. And then on the right, we have two more cases, which is going to be the bear call spread, and in case you haven't guessed it, the bull call spread, which again, you have plenty of videos in our YouTube channel that talk about all of these. I'm just doing a summary to make sure we speak the same language. But I do need to have this summary at the speed of the light so we can focus on the lesson, okay? So, so what do we have here? So because, again, going back to what I said before, when you... I just did that backwards. Sorry about that. Bull. Sorry, guys. If this was not confusing enough, I just confuse you more. So when going back to basic of options, when you buy a call, it's bullish. When you sell a call, it's bearish. So when you do buy the 70, sell the 80, that's a bull call spread. When you sell the 70 and buy the 80, that's a bear call spread. Okay. And of course, talking about the basics of options. Okay, talking about the basics of options, you also know that when you buy a put, debit, you need to pay for it. When you sell a put, it's a credit, you get paid for it. When you buy a call, it's a debit, you have to pay for it. And when you sell a call, it's a credit, you get paid for it. So in other words, the bear put spread is a debit, the bull put spread is a credit, the bull call spread is a debit, and the bear call spread is a credit. And all those combinations are made of using two different strikes, two calls or two puts, different strikes, 70 and 80 in this made-up example, but using the same expiration date, which could be as low as daily expiration options, short dated, 1 week, 2 weeks, or, all the way, 30 days, 60 days, 90 days, 120 days, depending on where your target is. The further away your target is, typically you need more time. So this is what a vertical spread is. Now, when looking at these strategies, the first thing that you will notice here is that this is directional. Okay, this is directional. Now, so doing a bear put spread, it's indeed directional all the way. Doing a bull put spread, it's directional, but neutral too, because it's a credit strategy. So when I do a bull put spread where I sell the 80 and I buy the 70, of course, if the stock goes up, I make money. But as long as the stock stays the same, or maybe goes a little higher, or maybe goes lower, but doesn't go below 80, as long as the stock on expiration is at 80 or above, this strategy profits too. So not only it profits as the stock goes higher, but it also profits based on time decay and having the stock not to move too much, and definitely having the options remain out of the money would make the strategy to profit. So it's what we call a neutral strategy. It's directional. In the perfect world, you want the stock to go, so you profit faster. But if the stock doesn't go, stays the same, or move a little bit only against you, just a little bit, so you may still end up in a profit. So it's directional neutral. For the bull call spread, it's also directional. You need the stock to move. And for the bear call spread, it's directional neutral. Okay, so we have all these various combinations that allow us with the vertical spreads to be either directional or directional neutral, and it's done again by combining two options, two different strikes, same expiration date. That's a vertical spread. Now, within being directional or neutral, okay, within being directional or neutral, you could end up, let me make a bit more space on the screen. I need more space. So within being directional or neutral, you can be more aggressive or less aggressive when it comes to the deltas you want. If you recall, deltas have two interpretations. If we talk about options pricing models, and this is, again, I'm just going speed of the light here, but you could think of delta as probability of profitability. Another way to say that is probability of having the options to remain, probability of having the options to become in the money on expiration. So the lower the delta, the more the probability the options will remain out of the money. So if you sell a bear call spread or a bull put spread, which is a credit, and you have a delta of 5, for example, you have 95% probabilities based on the options pricing model, which of course it's far from reality, but you got 95% theoretical probabilities that the options will expire out of the money, and therefore you will make a profit. So if you want to be not aggressive at all, you can use very little deltas, and therefore that means that you have a high probability of profiting. Of course, you get paid little credit because you are not aggressive, you take less risk, and therefore you get paid less. If you want to be more aggressive, then you sell bull call spreads or bull put spreads or bear call spreads, which are closer to the current price, and therefore we have a greater delta. And if they have a greater delta, it means they have a higher probability based on the pricing models to expire in the money, and therefore you have a lesser probability of profiting, and therefore you get paid more credit. So if you want to be more aggressive, you use more delta. If you want to be less aggressive, you use less delta. This is for credit, but to be honest, for debit strategies, which is the bear put spread and the bull call spread, the same rationale applies. The very same rationale applies. If you buy, for example, the 70-80 call, okay, these two guys, okay, you buy the 70-80 call, you're gonna get X amount of deltas, let's say 20. Let's say you want to be more aggressive. Well, instead of buying the 70-80 call, you could buy the 60 and 80 call. That will give you more deltas, and therefore the trade will profit faster with direction. You are more aggressive, but it will cost you more, so you have more risk, which is you are more aggressive. Or you could say, okay, wait a moment, the current price is 70, but I'm gonna buy the 75-80. So you push the whole spread higher. So you are actually buying an option. You're actually buying options out of the money. So they have less delta. So they're gonna be cheaper. So the most you can lose is less. But again, the probability of profiting is less, so you have less risk, but also potential for reward is less because your delta is less. And again, you can see that as you move the strikes, because the expiration date is the same for vertical spreads, right? So there's nothing to talk about here when it comes to expressions. But as you move the strikes, you end up either collecting more credit or less credit, or you end up paying more debit or less debit, and it all has to do with, depending on where the strikes are, you got more delta or less, which makes you more aggressive or less aggressive within the context of being directional or directional neutral, based on the 4 choices I just gave you. And this, my friends, is a crash course on vertical spreads at the speed of the light. And to be honest, it was not fast enough because I need to make more time for what we need to do on the platform. Okay. Now, the horizontal spreads. So the horizontal spreads are going to be made of using 2 calls and 2 puts combined. But in this case, what we're going to vary is the expiration date. So the way it would look like is something like that. It will look something like you buy a call and you sell a call, or you buy a put and you sell a put. And that is the same strike. So for example, if I pick 50, so you buy the 50 call and you sell the 50 call, or you buy the 50 put and you sell the 50 put. Now, of course, if you use the same expiration date, then you buy the 50 call and you sell the 50 call. Well, the call you bought, you just sold it, so you got nothing. You are flat. So, of course, you have to use different expiration dates, okay? So I'm going to use, buy the call, I'm just going to use superscript, for example, 30 days to expiration, for example, and you sell the 30 call that expires in 5 days to expiration. So maybe you do something like that, or same on the put side, where you buy the 50 put and you sell the 50 put, and again, you're using a different amount of days to expiration, okay, just to use a bit more proper terminology, days to expiration, DTE, okay? So that's that. And now, what would that do for you, right? So what's the benefit of doing that kind of thing? Well, the benefit of doing that kind of thing is that depending on the strike location, right, depending on the selection of the strike, this trade could be directional, but it's never going to be aggressively directional because you buy a strike and you sell the same strike, so the deltas are going to be offsetting each other. You will have a difference of delta because you have a difference in the expiration date, but you can never have a very large delta value because you buy and sell the same strike, even though it's 2 different expiration dates, it's still the same strike. So it's kind of delta neutral, okay? It's kind of delta neutral, and no matter what. Okay, now, is delta neutral? It will be a debit, but while it will be a debit, while it's going to be a debit, it will produce a positive theta. This is something which is pretty cool. So you are doing a debit, but you are being paid as time passes, which typically this is not something that happens with debit strategies. Debit strategies typically are negative theta. You lose value on time passing. But with the horizontal spreads, it's not the case. So the beauty here is that with a horizontal spread, you have a very mild exposure to direction. So you don't make too much money on direction. And actually, the worst case scenario is that the stock moves all the way to your target in one day. You want the stock to take its time to go to the target because you profit on positive theta, apart from some delta exposure. So you want the stock to take time. But the beauty is that then if the stock was to move against you, so while you would lose because it's a directional play, the reality is that you lose typically less than expected, little by little as time passes, because you are in a positive theta position. And also the benefit of the horizontals versus the verticals, which is a direct consequence of what I just explained, because it's common sense, is the fact that the cost of horizontals is going to be very little. Why? Because you buy and sell the same strike. So if I buy the 50 and I sell the 50, the cost of the trade cannot be too much. Even if I use different expiration dates, in the end, it's the same strike. So the amount of intrinsic value or the lack of intrinsic value, depending if you use in the money or out of the money strikes, will make the trade that you pay X amount and you sell it for X amount, where both amounts are similar. So the net cost of the trade is almost always going to be very little. So horizontal spreads are very, very low risk because they are very, very cheap. But then if you get a move, you get paid very slowly. So you better have the move to take place little by little. So you get paid on theta and the move. But again, the move is going to be little delta, a small delta. So you get paid little, which is why it costs you little, right? So low risk, low reward. But this is indeed low risk, which is cool. In a way, it's almost kind of like having a hedge built in the trade. Where with a directional spread, especially if you do the bull call or bear put, the ones that are debit, you better get the move. If you don't get the move, you make nothing at all, right? With a horizontal spread, well, you know what? As time passes, you are making some. So we are now speaking the language I needed you all to speak, and I know some of you know this by heart, but also I know that some of you may be watching this recorded, and this is fairly new to you. So hopefully, even though I did went fast, you can always rewind, re-listen again, or watch the other videos we have in the YouTube channel that talk about options. But hopefully this is now making sense and we are all speaking the same language. For the ones of you live with me, please on the chat box, give me some feedback if I went too fast, if it's clear or not. Please let me know. So as you answer, I'm going to get into top and we're going to start talking about finding these opportunities and then building the trade with the right strike. But before I even build the trade with the right strike, I want to use my matrix to look for the type of opportunity that makes a lot of sense. And here, if I go back to my notes, and I'm going to be looking at the chat box, okay? So please, everybody participate and give me feedback. So as I look at my notes, here I have debit, credit, directional neutral. So those are the things I have in my mind. Debit, credit, directional neutral. So what can I do? Well, when I go find my opportunities, the first thing I need to define here, or something that would be very useful to define, is, okay, no matter what I trade, no matter the stock I look at, I'm going to be looking at options that are expensive, CIV mean greater than 80, or options that are cheap, CIV mean less than 20. For example, if I select greater than 80, okay, and I don't even know what else I have here, so let me see, let me uncheck everything just in case. Okay, everything unchecked. Okay, here we go. We'll talk about the filters in the bottom part. So the selection I did of looking here, scan one, options with the CIV mean to be greater than 80, that if I was to use, just easy words from the English dictionary, words from non-traders. So basically, you would be thinking expensive options. Okay, and if I'm doing expensive options, so going back to my notes, what am I doing? Well, I'm looking for credits, credit, and credit. That's what I'm looking for, right? So in other words, if I plan to do bull put spreads or bear call spreads, which means that based on my trading plan, which all of us are different and have a different trading plan. So if, let's say, your trading plan says that you are looking for directional to neutral opportunities, and the way you analyze the market, you believe the S&P is going to do this or that or whatever, and that leads you to think, I want bear call spreads or I want bull put spreads, right? Another way to say that is credit spreads. So if you want to do credit spreads, so rule number one of the filtering would be you want, to have expensive options. This could be accomplished in three ways, which is select CIV mean greater than 80. That's choice number one. Choice number two, you can look at CIV mean above two standard deviation of the historical volatility range on the last 45 days, that is also expensive options. Maybe a little less expensive, but this is also expensive options. And then the third case would be, and this, I will let you, when you watch this video, to pause and rewind and take a screenshot if needed. And the third case is looking at options where the CIV mean is the top percent increase in the CIV mean in the last 5 days, meaning that those are the options that have increased the most in value in the last 5 days. So they may not be the most expensive options in the market, but definitely they went up by a lot in the last 5 days. So if they went up by a lot in the last 5 days, they're not cheap. They're expensive options. Okay, so the three choices I gave you is expensive options. The opposite is true for cheap options. So if instead of looking at CIV mean greater than 80, you look at CIV mean less than 20, this is cheap options. If instead of looking at that, you look at case number 2, remember there were 3 cases on how to find expensive or cheap options. So case number 2, you look at CIV mean below 2 standard deviations of the historical volatility in the last 45 days. If you look at this one, this is also cheap options. Okay, and obviously you can see how, given what's happening in the market, options are expensive overall, so there are few cheap options. Okay, which is normal. This depends on market cycles. If I was to do this recording at another time, we may not have expensive options, we may only have cheap options. These things vary, okay? And case number 3 is the top percent decrease in the CIV mean in the last 5 days. And if you were to look at that, this is also cheap options. They may not be the cheapest options in the market, but they are the ones who decrease the most in value in the last 5 days, so they are definitely not expensive. Okay? Okay, so if I was to do that, if I was to shoot for cheap options, what am I doing? Well, now I'm looking for debit strategies. So bear put spread or bull call spreads or horizontal spreads. Okay, because horizontal spreads are also debit. So every time you see the word debit, you want cheap. Every time you see the word credit, you want expensive. Okay, so this is step 1 in the filtering method. Okay, so if you're looking for cheap, you use the 3 cases I showed you. If you're looking for expensive, you look for the other 3 cases I showed you a month ago. Let's say you are looking for expensive. So I'm going to go for CIV mean greater than 80. So let's say you're looking for that. Now, what else? Well, I know because I'm looking for expensive, I'm looking for credit. That's what I'm looking for. Great. But what type of direction I need to define now, because this may be bearish or this may be bullish. So I got a credit bullish and I got a credit bearish. So now I need to define the bias of the trade. Am I looking for a trade which has a bullish component or a bearish component? Knowing that credit strategies are directional and neutral, but even though they are neutral, they are not totally neutral. This is not an iron condor, which is non-directional. This is not non-directional. This is directional, neutral. Okay? So I need to set some sort of a directional component. How can I do that? Well, you can come in here again and look for directionability from the options world. Even without looking at the chart, only looking at the options, you can pick top positive CIV spread. And if I do that, that means that the options markets show bullishness. Positive equals bullishness. It means that, in this case, spread refers to the difference between the implied volatility of the call, blue line, compared to the implied volatility of the put, gray line. So if the spread is positive, it means bullish bias by looking at options prices. Later down below here, we will also look at the chart, the candlesticks, all of that. But now we are not even get there yet. We are just looking at options. So number one, we selected options that are expensive. We want this because it's a credit. Options that have bullishness built in, which means that in this example right now, I am looking at building bull put spreads, which are bullish credit, where I got either a little bit of a directional bias to the upside or neutral, but if any, neutral bullish, not neutral bearish. That's what I'm looking for. And in order for me to find these type of opportunities, I would be filtering this way in this beginning part of the scanning. If instead of looking for credit bullish, I look for credit bearish, I guess you guessed it, on the second component, I'm going to go for negative CIV spread. So I still want my options to be expensive, but now I want negativity when it comes to the implied volatility of the puts compared to the implied volatility of the calls. So that means that there is a bearish bias built in the options prices. Okay, so now I can do my bear call spreads. Bearish because I selected top negative spread, and credit because I selected a CIV mean above 80%. Isn't it? So please, confirmation up to this point, because if this is clear, now I'm going to work on the bottom part. Okay, I'm going to work on the bottom part. And while you confirm, so for a moment, speed of the light, let's pretend I want it to be debit and bearish. So if you want debit and bearish, what would you do? Well, if you want to be debit and bearish, you would leave negative, which is bearish. But because you want debit, you want cheap options, so you would change this to be below 20 instead of above 80. So now this is cheap options for a bearish setup, or cheap options for a bullish setup if I select the word positive. So 4 cases: bearish for a credit, bearish for a debit, bullish for a credit, bullish for a debit. And inside the platform, you would think of less than 20 is cheap, debit, more than 80 is expensive for a credit, positive is bullish, and negative is bearish. And with that, you end up with those 4 combinations, which is, again, it's all you can do with options. Be bullish or bearish, more or less neutral. That's the beauty of options. But on the chart, if you wish, bullish or bearish, when it comes to what you think the stock is going to do. And then you can be looking for cheap options and therefore buy them, so debit, or you can be looking for expensive options and therefore sell them, so credit. So far, so good. Great recap. Love it. Thank you, guys. Thank you for the feedback. So now, what else? Okay, so by the way, if you are doing horizontals, okay, debit horizontals, okay, so the call side, which, by the way, I didn't say it, the call side would be, here we go. The call side, not like that. Here we go. Oh yeah, I'm like, what's happening? Okay, I know what's happening. Sorry, guys. Let me fix it here. I was using a superscript. Okay, here we go. So this is bullish, and this is bearish. Okay, so with the calls is bullish, and with the puts is bearish. My bad, I forgot to put this. Okay. Okay, so if you wanted to be bullish with the horizontals, you would scan for it the same way as the debit bull call spread. That would be the same as bullish here. Same thing. Now, what's the difference? The difference is what I said before. The difference is the option strategy, where the horizontal spread would pay you very bad if the stock went to your target at the speed of the light. You will want the stock to move slowly, right? Whereas the vertical spread would pay you very badly if the stock took forever to get to the target because you suffer time decay. Okay, so this is the difference. Okay, this is the difference. And same with the bearish. Okay, I'm not going to say it because it's common sense. Okay, mirror image. So you would scan the same. Now, what else? We have many more possibilities for filtering in this part in top. So you can be looking at stock filters, and I'm going to say that at the speed of the light, but if you have been in my sessions, I always care about the group. So when you are trading to the long side or you want to be bullish, certainly you want the group to also be bullish. So if you're trading, let's say, stocks that belong to financials, so you want the financial industry, the financial sector to be up. So your stock is more likely going to be moving up because all the stocks that belong to its group are also moving up, or at least many of them. So you will want to check, depending on the timeframes that you use and your trading plan, you may look at the long-term trend, the mid-term trend. If you are more aggressive, maybe you don't look at the trends. You are just looking at, okay, so has this stock rotated, has this group, not the stock, sorry about that, has this group rotated up in the past 5 days? So you have some beginning momentum to the upside in the group, and you bet that the stock will go and that the group will push it up. So maybe this is part of your trade plan and way on how you trade. So you would want to check mark and tick whichever places make the most sense to you. Again, with that depends on your trading plan. So I'm just giving you generics here because everybody's different and everybody has different rules in the trading plan, but this will be the rationale behind it. Another aspect you may be looking at when bullish or bearish is maybe Elliott wave turning points. So you may be looking at, maybe you are a longer term trader, so you are focusing on long term Elliott waves only. And as long as you have an up indication of Elliott wave, let's say in the last 3 bars, this is part of your trading plan, and you will be like, yes, I'm going to go for it. Now, of course, if that's bullish, you also want this to be bullish, right? So you want it to be positive, not negative. Okay. So options are expensive. You have a positive CIV spread, and in the last 3 bars, you have an Elliott wave turning point. Do we have anything like that? Actually, we have 2. Okay. So out of curiosity, I could be looking at that, and if I look at the chart on a daily time frame, okay, so we can see how in the last 3 bars we got the Elliott wave turning point, which is the orange dot. But you also know that stock, okay, let me go ahead and insert trend for the group long term. Okay, so the trend for the group long term is blue, right? So the marine transportation sector is going up, and that stock is now moving up with an Elliott wave with a potential target around 55, 57, right? So maybe you want to set up an options trade there with that stock, knowing that the options are expensive and knowing that you have a bullish component on the options prices too. So you have a lot of bullish indication for the stock and the group, and you may want to do a bull put spread. Why a bull put spread? Well, because the bull put spread is when you do credits and you are bullish. And in our filtering conditions, so we had a CIV mean greater than 80. So this is expensive options. Okay? The banner is blocking what I just wrote. Oh, I'm so sorry about that, Mark. Okay, I will show it to you again. Let me do this. Let me do this. Okay, this should be better now. Cool. Okay, let me take a sip and let's keep going. So, um, again, all of this depends on your trading plan. Maybe you don't care about Elliott waves; it's not part of your trading plan. So then you uncheck it. Okay. Um, then you got earnings. Okay. Like if you are directional, probably you want to avoid earnings. So you will want to exclude, for example, the next 30 days. So you can have the stock do whatever it has to do, but not find yourself in a situation where earnings are happening and you are in the middle of the trade before you got to your target. And now, because of the earnings, maybe they are bad or good, and next thing you know, you have a gap against you. Okay, it was all nice for many days, and then the kind of like the last 2 days of the trade, everything got messed up because of earnings. So you may want to avoid those situations. So you may want to filter out those earnings stocks. Okay, and then stock price range. Maybe you just want to trade stock with a certain level of volatility. You could specify volatility percentages here, and then maybe auto climate. Maybe you are looking, okay, so I want my climate to be up and sensible, and then I'm going to go into the trade. Okay, and in this case, we don't have any case yet. Okay, because of course, the more check marks, we talked about that in the past, the more check marks that you have, the pickier your filtering is, and of course, you can have more odds for success, but you will find less trades. And therefore, it may or may not work for you depending on if you want to be very active or not so active. So that is something that you need to decide for yourself after you do your analysis, your backtest, and all of us have a different trading style. You may be very aggressive 10 times more than me. Maybe you are super conservative 10 times more conservative than me. We're all different. Okay, so that's why I'm giving you choices here, but you understand the rationale of what I'm doing. Okay, so we're getting into the last part of the session, right? So we talked about what are the verticals, what are the horizontal, how do we find opportunities for that, right? And now the next question is, how do you build a trade? Okay, how do you build a trade? Well, in this case, I selected a bull put spread, which is a credit strategy. Okay, so let's build a bull put spread. Okay, so the first thing that I like to do is find, if this is gonna be my target because it's the Elliott wave orange area. So, and again, setting targets, each of us may do it differently because of the tools that you use. Maybe you are using, pivots, and you put your pivots here, and therefore your target is gonna be that line at 57. Okay, instead of 55, it's gonna be 57. So we're all different. So let's pretend this is your target. So I'm going to right click, send to the strategy builder. And when you know that, the reason why I'm doing that is so I'm going to get a target date calculated. If you don't use top or you don't use a strategy builder, you need to find out a way to find out dates. In this case, the date is November 12th. Okay. In other words, based on a very smart calculation, it is calculated that a normal thing to happen to get to this target would be to take time all the way until November 12th to get there. That would be pretty normal, all the way to November 12th. So in other words, using an expression there, which is November 12th or more, in this case, is looking at January 19. Also, this is not the most liquid stock in the world, to be honest. It's really not good from a liquidity point of view. So, maybe not the, oh, actually it's better than what I thought. Yeah, some strikes are not good, 8, 89, 10, but some other strikes are pretty okay. So I guess that's why, because again, the strategy builder is intelligent. So that's why it went from November all the way to January 19, probably because it found liquidity a little healthier there. This is not Scorpio tankers. I never traded that stock before. Is not the most liquid stock on the S&P 500 market, okay? On the S&P market, on the US markets, I meant to say. But anyway, it's good for this exercise. So you may want to use around November, maybe December, maybe January. Of course, depending on your trading style, you may use a strategy builder and that's it. Or if you want to build the trade manually, you will probably end up using the option chain. Okay, load an expiration date after November. Okay, you got November 17, and then starts working on those strikes. Okay, and because a bull put spread is directional and neutral, so you would want to put that spread in a location okay, which is kind of like where you are proven wrong. So in this case, you have the Elliott wave turning point right there. You have this dotted line here that, if you were to be an Elliott wave trader, tells you that if that stock goes down and breaches that line, it means the wave failed. Whereas if the stock reaches this orange box or the next one, it means the wave propagated fully. And again, this is assuming that you're an Elliott wave trader. So then you will need to find out, you will need to use that dotted line as the place on the chart where you're proven wrong. In my case, I'm going to be a bit more aggressive because I am a UFO trader. While I do appreciate Elliott wave very much, beyond the Elliott wave, I am a UFO trader. So 45.95 or 45 in this case is the price I care the most about. Meaning that if that stock goes down and gets to the UFO, my understanding is that I got 60% probability that that market will go higher. So in other words, if it goes below the UFO, I am proven wrong, and then I'm going to be happy taking a loss. So 45 is my reference point to do the bear put spread. And in this case, it would be done by selling the 45 and buying one below, which is the 42.5. If I zoom in, okay, sell the 45, buy the 42.5 put, that means same expiration date, November 17, different strikes, 45 and 42.5. This, my friends, is a vertical spread. It's a credit spread known as bull put spread. So if I take a screenshot, of this, and I move to the Word document I was building, and I make this to be floating, and I push it somewhere here. So notice how a bull put spread, which we define as that column, bull put spread, sell a put above, buy a put below, 45 is above 42, sell above, buy below, same expiration date, my friends, this is a bull put spread. And if you were to do this trade, so this trade would pay you 50 cents. So if you're right, you make 48 cents, which is $48 per contract. And if you're wrong, you're going to make the difference between strikes minus the credit. You can always graph it. I'm doing this quick because it's actually the ending time of the session. So I need to do this quick. So the most you can lose is 200. The most you can make is 50. Why? Because the distance between strikes is 2.5. So the most you can lose is $250. But because you get paid $50 to risk 250, so the most you can lose is 200, and the most you can make is 50. That's the trade. And as long as the stock is above 45, you make 50. So the stock is currently trading at 51, right? The stock is currently trading at 51 or 50.99. So if it goes up, you make 50. If it stays the same, you make 50. If it goes down, you make 50. If it goes down all the way to 45, you make 50. If it goes below 45, you lose 200. So there are many cases where you can profit. There is one case where you can lose. Of course, the size of the loss is greater than the profit because it's a credit strategy, and credit strategies are always like that. Now, what if instead of a credit strategy, you want to do debit, either vertical or debit, either horizontal? What would change? Well, what changed is, of course, we need to use a different stock because that stock has expensive options. I cannot use expensive options if I'm doing a debit. I need to use cheap options. So if I move to less than 20, I end up with a different set of stocks. Let me do the Elliott wave just so it's the same thing. I don't have anything like that. So let me go ahead and look for bearish instead of bullish. And therefore, my Elliott wave needs to be down instead of up. I'm not sure we're going to find opportunities. Yes, because it's been dropping for so long that it takes more of a retracement. So what if I do medium term bullish with bullish, Again, I'm just trying to find an opportunity for this practice. What about dynamic? What about short term? What about this one? Oh, earlier I was looking for up. Sorry. So, okay, let me try again. I'm just rushing it, and this is the recipe for mistakes. So let me take a look. So we are looking at down, 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 and we are looking at negative. Let's see if we got something. Short term, long term. What about medium term? What about ultra short? I just want an opportunity so I can do the practice, guys. I'm not even looking at a good trade at this moment in time. I just want to do the application. So let me uncheck this. Wow, there is no Elliott wave turning point yet. I mean, the market has been pushing up. My God. Really? That's real Murphy's Law. Okay, so forget about. Let me do one last try. 5 days. This is not how you find trades, okay? But again, this is not the point right now. I explained earlier how we find the trades. Now the point is I want to have something on the chart that looks like okay, so I can do the application. Okay, so let's say we have ATVI. ATVI belongs to software and programming, and the whole industry is down. And let's say you believe this is going down, and let's say you are setting your target based on this pivot point, and therefore you are looking at 91 something as the target. That's what you're looking for. Okay, so let's say that this is the case. Okay, and I'm just going to use another pivot point on top of this. Okay, and let's say that if it goes above 95, okay, you are wrong. So if it gets to 95, 91, you're right. If it gets to 95, you are wrong. Let's say that's the case. So what would you do? Well, the first thing is to calculate your time to target. So you would do the same with the strategy builder or a manual calculation you may do. This is telling us January 26. This is crazy. Completely crazy. So this price action has this crazy gap, and this price action is completely messing up the statistics of price movement here. Sorry for that, my friends. This is not an ideal example. Let me take a look at this one to see if the chart looks better. Okay, yes, we're going to use this. Okay, so semiconductors, we have the red UFO, so 56.5 is when we're wrong. Okay, and let me see, and I'm going to shoot for a target below this pivot low, which is going to be the end of this box, which is going to be 46. Okay, so 46.89 is the target. So time to target, again, the trading plan is what matters the least. I just need to come up with some numbers so I can plan the trade, so you see how the planning is done. Okay, so hopefully you don't get too bothered by that, because this is not the purpose for today's session. So 46.98 is supposed to be achieved in December 9. Okay, December 9. So let's say you want to do the trade manually. So basically you have two choices, and we need to compare a vertical spread and a horizontal spread. So this is bearish, so I'm going to use puts, and we said December something is when we're going to go there, so I need to use minimum December expiration. Okay, minimum December. Now for the vertical, with December I got enough. I am proven wrong at 56, so the nearest price is 55. So let's say I buy 55, and my target is 46 something, so the nearest price is 45. So let's sell 45, So in other words, if I zoom in, notice how if I buy, sorry, I clicked on call. How come I clicked on call? This was a big mistake. Both should be put. Okay. Why October? My friends, I did something wrong here. Sorry about that. Let me do it again. Okay, so I buy the 55 and I sell the 45. I'm not sure how I did it earlier, but definitely it was wrong. Now it's right. So if I do that, okay, I buy the 55, I sell the 45, both puts, both December expiration. This is a vertical spread, okay? And if I do that, notice the delta is 34. Okay, my delta is 34. So take a look at this. If I graph it, okay, here's the trade. So as long as the stock goes up, I go in the green. If the stock goes up, I go in the red. The most I can lose is 387. The most I can make is 612. Why? Because this trade is costing me 387. It's a debit. So the most I can lose is the debit. Okay? Pretty clear. Now, what if instead of doing a debit as a vertical spread, I want to do a horizontal spread, which is also made of two puts, but in this case, the same strike. So I'm going to use 45 and 45, same strike. I buy December and I sell, let's say, October. So if I do that, notice how the cost of the trade, it's 93. I pay less. Why? Because remember what we said, you are buying and selling the same strike, so it cannot be too expensive. Of course, it is going to cost you something because it's not the same expiration date, but it cannot be that expensive because it's the same strike, where in the case above, the strikes are wider. Therefore, it's going to cost you more. Okay? Now, notice how both trades profit as the stock goes down. You go in the green. Now, in this case, as the stock goes down, you also go in the green, but notice how the angle of profitability is less. Why? Because it's cheaper. So you get paid more slowly, which is you get less delta. The one above, you get 34 delta. The one below, which is the horizontal, gets you 10 delta, right? The one above gets you a negative theta, where the one below gives you a positive theta. We said horizontals pay you theta, where verticals, you make you suffer time decay. So, in other words, if I do the bull put spread like here, okay, if I do the bull put spread sorry, why did I say bull put spread? Bear put spread, okay? So bear put spread, this is the one I'm doing, and the one I did before was the bull put spread. Okay, those are the two screenshots that you have. Okay, I did both with puts. Okay, but one is bullish, one is bearish, one is debit, one is credit. So I think it's a good illustration. And the one, which is why I was looking for specific stocks setup, so I can do this demonstration. Even though these trades are probably not the best in the world, but they are very good exercise. And with the calendar spread, which is horizontal, calendar, and time spread is the same thing. So with the calendar spread, I also use puts. Sorry, I didn't click in the right place. Here we go. Okay, I also use puts. Okay, and in this case, he was the bearish one. That's the one we did. Okay, so this is what I was planning to do for today's session, my friends. This is an intense session, and if you are new to options trading, you for sure need to watch this again. Good news, is recorded. It's going to be on the YouTube channel, so enjoy. If you are more advanced, I'm thinking of you guys, Ahmed, Joe, Mark, Jeff, the usuals, right? So you kind of ask for this. So hopefully this is answering your questions. And if you have more questions, again, we'll meet again in a couple of Mondays. So bring the questions then, and we'll talk about it, or you can just post it on the website on the questions section. And happy to keep discussing this. But hopefully this session was what you needed. I have surpassed the ending time by 10 minutes. I apologize about that, but at least we could have a complete final conversation where everything has been addressed. Anyway, my friends, I will call it a day. Quick confirmation on the chat box, if you don't mind. Joe, I see your comments about the TSL. Let's talk about this in a different session, because basically that would have to do with defining directional or non-directional methodologies and how to scan and how to use TSL to define directional and non-directional. That was not the purpose today. The purpose today was what is a vertical, what is a horizontal, how to scan for it. Depending on your trading rules, which what you said has to do with your trading rules would imply to use TSL. Again, not everybody would use TSL, and my approach for the scanning was generic, so it applies to everybody. And once you have the opportunities, then how to build the vertical and how to build the horizontal for a credit or a debit in the case of the vertical. That was the purpose, and I completed that. So happy to talk about TSL and other tools that may help you to do a better job at picking either direction or lack of direction, depending on the type of trade that you want to do. But again, we have no more time, and it was not the purpose for today's session. So let's chat about it another time. Okay? Cool. Great. Great. Thanks, Jeff. Thanks, Joe. Thanks, everybody. Good to see you, my friends. See you in the next one. Take care, everybody. Bye-bye.